Hello and welcome to this edition of the Print Chacha. This is the 13th time that we're doing it. We talk to experts about various issues of the day of interest. And this time around, we're going to be talking about something that really, really matters to you, me, everybody watching this. It's the question of, is the growth in credit card and also in the growth in personal loans, is that really a cause for worry? Or is it not? And why I ask this question is because there are various perspectives. There are some people who say that increasing debt is, of course, a bad thing. But then there's the other side that says that debt-fueled growth is a legitimate kind of growth and it's a legitimate driver of growth. And as long as this doesn't turn into bad debt, it's all fine. And with us, we have an amazing panel of experts. One is Mr. Saugata Bhattacharya, who is the Executive Vice President at Axis Bank. And our second panelist is Mr. Rishi Shah, who's a partner at Grant Thornton India. And now why I say they're an amazing panel is because previously in various stories I've done, I have spoken to both of them for quotes. And in just a few lines, they've been able to encapsulate everything that topic requires. So now we have them for a full discussion. So it's sure to be a really, really interesting one. Thank you, both of you, for joining.
Thank you.
My pleasure. Yeah. Thank you.
And first of all, also, thank you to all of our subscribers. Now, this is a live event designed solely for you. It's one of the various benefits you get from subscribing to The Print. I mean, of course, the first is that you get access to these live events and various different in-person and virtual events that we have. Then there is also a your turn section that we have where you can write in to us and your opinion is published as an article. And finally, of course, by subscribing, you get access to our the newsletters that our editors send out, including me, including our political editor, opinion editor, all of us. We write newsletters about the news of the day, and we send this out to all of you, so you get access to that. And from our point of view, your subscriptions help us do the kind of groundbreaking ground reporting that we do. It allows us to send our reporters to far-flung areas in the country to bring you stories that nobody else will. So thank you so much for subscribing. And on that note, let's get started. So now we know that credit card debt has been rising, but I'll start with Mr. Bhattacharya. Could you tell us a little more about what the trend has been? Credit card debt, personal loans in overall, and of course also unsecured loans, which seems to be worrying the RBI a little bit now.
So first, Sharad, thank you very much for this opportunity of joining you. My privilege
You're most
to
welcome,
be part of your subscribers. Really nice to be joining. In terms of growth in unsecured loans, unsecured means essentially it's the personal loans and the credit cards because there is no collateral underlying these loans.
Right.
Home loans or loans against property or auto loans or whatever, where there is something which is underlying the loans, an automobile, a home, or a property or whatever. So in this case, both personal loans as well as credit card loans, and that's why the rate of interest is so high, comparatively high in
Right.
these categories. It has actually been the retail segment which has been driving credit, not just for banks, but also for NBFCs. Banks are the primary issuers of credit cards. NBFCs are not typically allowed to do. I mean, they are just originators of credit cards, and then the risk carries on to banks. So credit card growth has been about 30% year on year for the last 2 years, etc. It's still running at about 29% year on year. The last August we have. So we do see that in terms of the total amounts of loans, personal loans are quite big. So of the total 45 lakh crores of retail loans, about 25 is home loans, about 12, 13 is personal loans, and credit card loans are small, about 2 lakh crores. But they're growing very rapidly, the outstandings on credit cards. Till now, there has been no sign, not just from our bank, but across the system, the whole banking and the NBFC system. there's been very little evidence of any major material stress coming up in any of these categories. But
Okay.
services credit, in other words, I mean, the last numbers that we have for the month of March for FY23, that's been relatively high, about 7%. But for credit cards, for other personal loans, it's about 4%, which is in line with the total average, the GNPAs, the gross NPAs. Net NPAs for which banks and NBFCs have provided for these bad loans, that's even about 1.6%. So as of now, there are no signs of stress. But as Governor RBI and various other officials have been talking about this, everybody is keeping a tight watch on how things move. There's been no trouble yet, but in case something happens with interest rates remaining high, banks and NBFCs, I think, are prepared to deal with collections and other features when these loans go bad. So no particular concern as of now, but need to be monitored very carefully.
Right. And Mr. Shah, now carrying on from what Mr. Bhattacharya said, the one thing he mentioned that struck me was that home loans are a big part of this. They're the biggest chunk, in fact. And now the thing is that the government, and even going by the minutes of the last monetary policy meeting, the experts in the government seem to believe that increasing household debt when they're to take home loans and to take vehicle loans is actually a good thing because it powers consumption and it drives growth. Now, is this something that you agree with, Mr. Shah?
So absolutely. So let me start by again thanking you, Sharad, for having me on board, and especially with
Thank you for joining.
So to your question particularly, it's an emphatic yes. If anybody who's following the markets or who has been following not just the Indian markets but globally, you would see that there is a housing index in the US that they follow. I mean, who will actually take out a housing loan? You're essentially looking at something which goes beyond a 7-year period. Normally 7, 10, 15, maybe even 20 years, given what the person can get from the bank. Now, you ought to have some kind of confidence to be able to think that, yes, I will continue to service a particular loan for the next 5, 7, or maybe even 15 or 20 years. So the way they've actually put this is a sign of confidence. This is a sign of possibly the fact that, yes, formalization as the economy goes through that, more people have incomes as the banking services grow. People know that there is this access to credit that they can get. And hence, I mean, I really don't see this as in any way a negative. Particularly on the housing side. The other thing you must notice is that over the last 10 to 12 years, the housing market had been quite muted. I mean, especially after the 2008-9 crisis, a lot of money was stuck there. In the last, I would say since the pandemic, wherein the demand for housing has actually grown, RBI data itself shows how housing prices have moved up. It has become more lucrative. The other thing is it is also an avenue to save tax. I am, rather than keeping my money in some financial savings, I mean, I may not want to put it anywhere else. This is a very, very good option, a lucrative option, because there is a net gain because property prices may go up. I may also save on tax. So, overall, like I said, I actually agree with that assessment. One minor point here, all of our analysis is backward looking. We look at data from the past, say this is happening, that is happening. There will be behavioral changes as the Indian economy grows. You're looking at trends when the Indian economy was barely $1 trillion. Now you're at your $3.5 trillion. People will become more ambitious. You're more globalized. So there are other, aspects to this which will actually drive growth in debt.
Right. And now what I wanted to get at from both of you was what picture of the economy does this actually paint? Because are house sales and car sales actually growing commensurately, or is it that more people are taking more loans to buy the expensive cars, whereas the lower end cars are not being sold as much? And the same with houses. Is it that houses in places like Bombay, Delhi are getting sold, but not so much in the tier 2, tier 3 cities? So, Mr. Bhattacharya, if you'd like to take that.
So let me start. So the data that I've seen actually suggests, I mean, there is an element of premiumization. There is no doubt about that. So I mean, higher end cars selling, because one reason, of course, is that lower end cars, because there have been so many add-on costs, emissions costs, etc. That the costs have increased in the small ticket segment. I mean, there is no doubt. So it's becoming more
Right.
and more unaffordable. So that's one of the primary drivers. So it does appear that the sales are increasing in not just tier two, but tier three and lower cities. Sales of
That's good to hear.
premium vehicles. Yeah.
Oh, that's
So
very good to hear.
yeah, so I mean, it is. I mean, so incomes are growing. I mean, obviously, I mean, I mean, the number of taxpayers, as you know, have increased. So all of that. So it is. One thing that I need to point out is that this is, although the data, the bank credit and NBFC data pertains to home loans, etc. When we talk about households putting on more debt, the way that RBI and the government and the National Statistical Organization define households is only about 50% of households like ours, the viewers,
Oh,
mine, Rishi's. So a large part of this are actually the very small, micro and small businesses. Yeah,
I see. Right.
the kiranas, etc. So there, I mean, the National Statistical Office savings and investment data seems to suggest that there has been a significant investment in not just buildings and apartments, but also machinery and equipment. So that is exactly what you're addressing in terms of productive capacity getting added. I mean,
I
small.
see.
So all of that. So that needs to be kept in mind, because and this gets actually classified as household investments or household savings. There's been a big debate on I'm not going to get into that on the side. But be that as it may, personal loans, credit card loans, there is that issue of the end use of these instruments, these vehicles, which we need to. I'll get into that in more detail later. But that also seems to suggest that there is some element of consumption demand underlying the increased personal loans, the PL loans, and the credit card loans. It's not just totally investment.
Right. And Mr. Shah, your take on this? I mean, whether the sale of houses and cars and everything, if it is moving in the same way as the credit is. And basically, what I'm trying to get at is people keep talking about this K-shaped recovery and rising inequality, and how it's the rich who are increasingly buying things and the people at the bottom are not. But from what Mr. Bhattacharya says, there seem to be green shoots, some heartening signs of even the lower ends increasing their consumption and the purchase of assets.
Right. So absolutely, Sharad. I mean, I'm glad that Bhattacharya actually brought that point out. So there's no running away from the fact that there is some sort of a K-shaped recovery, as they call it. Of course, if you were to look at the data from since the pandemic or the general trends, the people who were in, say, the MNCs in proper jobs, they've tended to do much better than the other part. The big businesses have done much better. That being said, I mean, I do understand there is a component which has suffered quite a bit. But when you start looking at hard data on the ground, again, I give into the point that there is premiumization. Sort of, you've got very expensive cars. You look at big, metros like, say, Delhi, Bombay, Bangalore, and you see these, big time designer clothing brands and car brands actually coming in, investing in India, wanting to. So they know that there is capacity for them to buy. But very importantly, there are other aspects to it also. People have, look at it, what cars are getting sold. I mean, it's not just a Maruti 800, that's not, or the Alto or something. There are the people, even at the base level, are wanting better, more amenities, better kind of cars. So, that change is there. Your per capita income, while it's not at the best possible, sort of position, but it is going up. So it's, the wonderful thing about economics is that, yes, you can take either stance and you continue to justify it. But, I think there is a good middle path here. And I don't really see it as all gloom and doom, because, having looked at things, how they've moved in the last 15 years, there were times of, wherein there was unrest and people were generally, affected by what they were getting and, what kind of income growths were there. at this point of time, any young person who can get skilled has so many opportunities, has so much to do. So, and the data reflects that. So, so much of data even buying cars and on all of that. So I think it's a fair point to say that it's not all gloom and doom. That there are positive aspects to this story.
Right. And I think it is an important point also to make that home loans and auto loans, especially, they're secured loans. They're taken against the asset, right? So this the increase in lending, it also shows that there is an increase in the purchase of these assets. It's not, you can't go to a bank and say, some amorphous thing, I want to buy a car and so please give me a loan. They will need the details of which car and everything. And same with the house.
Not just that. I can tell you from personal experience, I bought a car 4 months back. I had to give 6 months worth of my, whatever my pay slips were, my ITRs for the last 3 years.
Right.
Everything had to be given. So point is, if a bank actually is going through all that process of actually ensuring that the person is credit worthy, then, you ought to also recognize the positive side of it.
Right. And now, Mr. Bhattacharya, are there similar checks that the NBFCs also do when they are lending? Because NBFCs also largely are lending for a lot of consumption-driven activities.
Very much. So, before I get into that, let me just give you some numbers on the questions that you had asked before. So,
right.
The total number of originations meaning, you get the feet on the street, the relationship managers, etc., that who bother all of us, all of your viewers would know, they would have got calls, etc. So that's the origination of that loan, and that's not a complete approval, but that's where the loan process begins. The first process is inquiries. Yeah, so banks will inquire, as Rishi was saying. So the moment they get an application for a loan, they will go to the credit bureau and check the scores, etc. That's the inquiry that the bank or the NBFC does from the credit bureau. In terms of originations, in the RUSU, what we call RUSU, rural and semi-urban space. So 50% of the originations of new loans, both banks and NBFCs, 50% is from RUSU. The rural and you remember we were talking about the tier 3, tier 4 cities.
Yes, absolutely.
That's what is the RUSU area. 50% of total originations are from there. Amongst the young people, young defined as 18 to about 30. Yeah, so 31% of these new loans are originating from young borrowers. The new to credit, which is something which is a risky part, because this part which in India is getting formalized. This segment had not got access to credit, that they didn't have credit cards, they didn't have formal loans, etc.
So you don't even know their credit worthiness.
Yes. So now this is the role that NBFCs and fintechs are playing. Using their data, their analytic skills, they're beginning to get this so-called new to credit. So all of us in our gathering here are probably existing to credit. So banks know we have bank deposits, etc. But this lot of the new to credit have no credit history whatsoever. They are about 16% of the total originations. And amongst all the originators, that is to say potential borrowers, 38% are actually good quality so-called prime borrowers. There are prime, there are super prime, there are subprime borrowers. 38% of the total originations are prime borrowers. That's a brief profile of the various characteristics of the new borrowers. Most of it seems to suggest that the risk levels are being controlled. It's not indiscriminate. The other part in terms of riskiness, of controlling risk, is that approval rates for the prime borrowers has actually gone up from March 20, 21, 22, 23. But for the subprime borrowers, they have come down. So in other words, of the originations, the NBFC origination or the bank RM origination, not all are approved. The approval rate is only about, for credit cards, it's about 26%. So that's a very low approval rate. Yeah. So, banks and NBFCs have these controls in place. But again, as Rishi mentioned, this is backward looking. Going forward with these high interest rates, things begin to move in a very non-linear fashion. So something might break, but I think banks and banks and NBFCs, the large NBFCs, are adequately positioned to monitor these loans.
Right.
Right.
So,
But there's yes, sorry.
sorry, I'd just like to add in a point to what Saugata sir was saying. It's important to realize two aspects. Exactly, precisely what he had pointed. One, do they pose a systemic risk? Is the quantum that large that it can actually cause? It's good. Yes, of course, it is important to be cognizant of the risks that are emerging. That's one aspect of it. You cover your risks because nothing in life can be without risk. However, is it really causing that potentially big risk to the system? That's number one. Number two, it's the newer. It also actually helps boost growth, right? So our own bank is a relatively, in terms of global standings, I think the RBI does a fantastic job, and it's a very conservative central bank. Otherwise,
Fully
our
agree.
growth,
Yes.
I think hitting double digit levels growth, if we had followed the American / Chinese, whichever model we could have picked up, it could have been very easy. It can be a credit fueled growth kind of a scenario. However,
Yeah.
we don't do that. We are very, very, and I think Saugata sir can vouch for this. The amounts of checks and balances that the RBI has on banks and NBFCs also to an extent as to what kind of lending are they doing, the kind of reporting that they have. It is wonderful to see. You feel safe that way. So that's why I don't really see this as a big risk on the economy, sort of from an economy standpoint. Even for that, just the RBI itself coming outside and saying that, we ought to be monitoring this. It's an indication to the banks to just be careful, right? So that's the way I sort of read the situation.
Right. And now there was something very interesting that Mr. Bhattacharya mentioned, which is that, there's the prime, there is the super prime, and then there's the subprime category of borrowers. Now, I'm not from a bank and I don't know intrinsically how they operate, but why would they at all lend to the subprime category?
As you mentioned, Sharad and Rishi, so there is banks are in the business of taking risk, right? So
Right.
we can't exclude a certain set of people because their credit scores, I mean, the prime, subprime, super prime, etc., are determined by your CIBIL, your Experian credit scores. I mean, all of us have credit scores. Yeah, so we can't exclude a large part because they are they're perceived to be risky. Banks and NBFCs have controls in place. So, I mean, for a riskier credit, whose credit quality is not very good, banks will automatically charge a higher rate of interest. Yeah. So,
Right, of course.
when you go shop around for home loans, etc., if you have a solid, superb credit score, 800 or whatever, banks will fight over you. Yeah, but for the other subprime customers, who have defaulted in the past, whose payment records have been little dodgy, sketchy, etc.
Right.
So they can also get credit, but they will get the credit at a very high interest rate because banks know that they are taking a risk with these.
Right.
Yeah. So they will try to price in that risk in the interest rates that they operate. Yeah. So you do not. So it is completely possible that somebody who's had a problem with credit in the past will turn out to be a very good credit prospect.
Of course.
But you need to cover for that credit risk. So, it's not that banks will absolutely not touch anybody. For the subprimes. So, you remember the global financial crisis. That was the US. The US where you could give credit to anybody.
Absolutely.
all manner of very, very complex and opaque structures were built on those subprime credit exposures, etc. Nothing like that. India does not have any complex instrument. It's just a plain loan. And as Rishi was mentioning, these are very granular loans. This is like 15,000, 20,000, maybe a 1 lakh, maybe 50,000, etc. These are not these large 5,000 crores infra projects. These are very, very small loans, granular loans. So the banking system is not taking on systemic risk. But of course, any possibility of a NPA, a bad loan emerging, needs to be controlled. The first step is pricing that loan correctly. The interest rate should be correct, and then banks, NBFCs are very highly capitalized. The common equity tier equity ratio is above 16%.
Right.
NBFCs it's about 23%. Yeah, so in the event of a default, the bank capitals can bear that loss. So in that sense, there's no systemic risk involved. But obviously, you should not let a potential problem come up without taking adequate checks and balances to control that problem.
No, of course. And now that you mentioned the subprime crisis in the US, we have a question from one of our subscribers, Mr. Aditya Chandra. He asks that with the rising credit card loans, do you think we're heading to the 2008 era where loans were disbursed? And now he's talking about India, where loans were disbursed to anyone and which led to a negative impact on bank financials in the form of NPAs. Do you think we haven't learned from that experience, which is leading to this kind of disbursement of credit card loans?
So, Rishi, you want to take that, or?
Sir, I think you should take the lead, and I will be happy to chime in.
Okay. Yeah. So no, banks have learned. Remember that even in the 2008 period, the retail loans was not the problem segment. The problem segment was the loans to the big corporates, the industrials.
Right.
No, so it was the corporate loans that got the banking system in trouble. It was not.
Yes, absolutely.
So even then, I remember from my own bank that we had started to cut down the exposures. The credit quality, etc. So the bars, the thresholds that banks set based on the credit scores, other qualitative inputs, etc. The thresholds that the banks set for taking on, for giving a credit card, etc. During even that period, I remember we had withdrawn a lot of the credit cards in circulation, as had the entire banking system at that point in time. And right. That the lessons have been learned very carefully. Now, the risk management systems in banks are much, much more robust, on both from a regulatory point of view, RBI has mentioned because of all the Basel III norms, etc., and in terms of internal bank systems, the risk management systems. Data is now much, much better. Banks have
it's more robust.
So, we know exactly what we are getting into. We meaning banking system, NBFC.
Of course.
We know. So, the situation is probably nothing compared to what used to be there. And it's not just for the retail, it's also for corporates and MSMEs, particularly the micro and the small businesses, which are similar in nature, in risk profiles to the household and retail loans that they have. So banks are much, much more aware of the potential risks that are building up in the system.
Right. Yeah. So, Sharad, just to add a couple of points here, I think it's fundamentally wrong to consider the Indian economy in the same leg as the American economy. And when you have thoughts of where the subprime crisis was, even at that level, the credit to GDP ratio for the US, I think it was above 100% easily at that time.
Even
in India,
yes.
Today, it's around 45% for households. So, there is no comparison there, right? And like I said, that the checks and balances are such in our banking system that this kind of financial engineering that sort of happened in the US is not happening in India. The RBI doesn't let it happen. So that's something that we don't really, I would not consider that as a risk.
Right. And now I know both of you have been saying that this credit growth itself is not a sign of stress in the economy and that it might actually be a good thing. But does that translate into even credit card debt? Because just anecdotally, we hear a lot of people talking about how they're spending a lot more on their credit cards. And for some of them, it might imply that their incomes are not keeping up with expenditure. But some of them, of course, also use these credit cards for the points. So one of them will have one credit card for the airline points, another one for the hotel points. And then at the end of the month, they pay it all off. So now, what is your read on just what's happening with credit cards? Let's start with Mr. Shah first.
Yes, I would. It's both sides again, right? It's a difficult one to call out exactly what is more prevalent today. But as the formalization of the economy improves, that people understand that rather than using a debit card, it's actually beneficial to use a credit card because it's not your money. Your money is not at risk. It is the bank's money. You still have a forum for dispute, and there are other things that you can do, and the rewards that you get by using this, and people who are in jobs, it just makes sense to not spend cash and not spend money through your debit cards for whatever, for risk of theft, loss, whichever way. So I think those are all factors which are also affecting, credit card growth.
Right. And Mr. Bhattacharya, you agree?
So to a very large extent, yes. We don't really know very well on the end users. So as you know, I mean, a lot of consumer durable companies now offer these buy now, pay later, BNPL type
Yes.
loans. Yeah, they offer loans on EMIs, interest-free EMIs. So I mean, you could spread your the total payment over a period of 6 months or 8 months or whatever, and with no interest.
Right.
With the banks or the merchants bear the cost, the so-called interest cost in these. So that is automatically leading to build up of balances. Because otherwise, I mean, prudent credit card users typically would buy on the credit card, because as Rishi and you both mentioned, it's much more beneficial to buy on a credit card, but you pay down the loan at the end of the month. You don't keep the balances.
Right.
Now with these BNPL type structures, with EMIs, etc., more and more people have built up balances for which there is no interest on the credit card. So that's one factor. The one other thing that way to look at this in terms, again, as I mentioned, the prime, super prime, and subprime. The
Right.
number of the upgrades in the prime categories. In the prime categories, there have been more upgrades. So I mean, from a subprime category into a prime, into a super prime categories. So the upgrades from the lower grades up to the higher grades are increasing. So that's one signal.
Oh, that's fantastic.
People are not really that stressed. The other part is in terms of the prime, the subprimes, etc. The total number, the share of the prime category has actually been increasing. The share of the subprime has been falling in the total credit, whether it be personal loans or credit cards or whatever. Both of these data points seem to suggest that it's actually the better rated, better credit score based customers that are driving the credit growth. So again, I mean, all of this, I mean, there is no real evidence of that. This is an indirect evidence, but it appears that the borrowers who would have been more stressed and are using credit cards to keep consumption even when their incomes are falling, because they would be categorized probably as more of the subprime, and that share of these borrowers is actually coming down, while that of the prime customers and obviously the super prime customers, that share in the total credit is actually increasing. So this is the good news.
So now, Mr. Bhattacharya, then now we have spoken quite a bit about how the RBI is a good regulator and it's actually been quite conservative and prudent. But there are things happening in the lending space that are outside the RBI's remit right now, which are the profusion of these lending apps. And there's just these fly-by-night apps that will promise you that, we'll give you a loan instantly, and they start you off on relatively lower interest rates, and then reel you in for further loans at higher and higher rates, and then you just get trapped. That would suggest that there's some sort of, again, is this pushing some sort of consumption-driven growth, as one of our subscribers also points it. He asks, is this driving this consumption-led greed, as he calls it, or is this again just incomes not keeping up with expenditure, even normal levels of expenditure, not super high levels?
So again, I mean, obviously, I mean, we don't know the numbers on this segment of credit providers and the borrowers who access that sort of credit. From everything that we hear about, and the governor also mentioned during one of his the governor's statement and the press meets after the Monetary Policy Committee meets, that this segment is relatively very small, but it's growing fast, growing rapidly. Very small. I mean, this is of the total credit outstanding for retail consumers of about 45-50 lakh crores for the banks and 10-12 lakhs for the NBFCs. This would hardly be 20, not even that, probably 20,000 crores. So it's a very small.
I see.
I don't think anybody knows the exact numbers, but these are presumed numbers. But it would be that order of magnitude. I mean, it's not large, but it's growing. Secondly, remember, this is just the digital version of what used to happen before with money lenders, with chit funds, etc. Right? I mean,
Of course.
it is exactly the
It's a
same.
formalization of
Done on an app. Yeah. So
Yeah.
done on an app. So all of that. So again, so the way to deal with this, because these entities are not, unlike banks and NBFCs and MFIs, the small financial institutions. So all of the microfinance institutions, etc. So MFIs. So those are the entities that are regulated by the RBI. These entities, the new lending apps and platforms, are not. So you
Yes.
constantly hear the RBI telling people not to be lured into these. The only way to deal with this is to increase the level of financial literacy. Yeah. So I mean, obviously,
course.
and they charge very high rates. So I mean, the rates are very, very high. Yeah. So obviously, I mean, the way to look at this is to get to the borrowers rather than trying to regulate these guys, because it's very difficult to try to regulate something that is not under the ambit of whatever. So the RBI can track. This is more a function of the Ministry of Information Technology, etc. It's not within the RBI's ambit to regulate. RBI and SEBI, etc. So all of the other regulators, financial sector regulators, need and have done this. I mean, the amount of the expenditures, advertisements, etc. that you see on newspapers and on digital media, you would be getting SMSs on your WhatsApp messages on your mobile phone.
Of course.
Try to increase the level of financial literacy regarding the risks that are coming in, that might come in from some of these apps, because the consequences of a default are very severe, as you would have read in multiple instances, anecdotal.
Right.
Yeah. So the way to deal with this is financial literacy, not by overt regulation, which is not possible for some of the regulators.
Right. And now I think we have a final question from one of our subscribers, Mr. Sanjeev Galwankar. I think it's a good way to sum up the conversation, which is, do we have any actual indicators? So now we've covered how, on the one side, this could be a good thing that this rise in credit is driving growth. On the other hand, we don't quite know whether it's showing some signs of income stress or all of that. There are signs that it's probably not showing signs of stress, but we can't say for sure. As you also said, these are indirect ways that we're being able to gauge that. So what would you say would be a good indicator that would point out whether it's the former or the latter?
So, I mean, it's a great question. And obviously, like all great questions, difficult to answer. It's really difficult to distinguish whether it's a demand side or a supply side. In other words, whether this shows a problem with the end use, whether the end use is more consumption which is relatively unaffordable. So income consumption in excess of incomes, etc. Whether it is that or whether it is more borrowing to invest in machinery, equipment, other education services, etc. So to improve your own productivity, or whether it is just being used for travel, whether being used for consumption. There are signs that this is being used for consumption, particularly consumer durables. That's where most of these BNPL schemes take into account. So on one side, not from the individual borrower, but from the segment, the consumer non-durable segment, because that's a major driver, because they have long tails, the dealerships, the vendors, and so on. So that's very good for economic activity. But for the individual borrower, this might present some individual risks, because if you over borrow, etc., and not unable to repay, so it's very difficult to get back a washing machine or something from people are buying mobile phones now on credit. Yeah. So I mean, if that is being used for gaming and for WhatsApp, etc., I mean, that's not a productive use. But if this is actually being used to learn data sciences, to learn artificial intelligence, that's a good use of that end use of that instrument. If you're both husband, wife are actually working, so many of the consumer durables actually make the household chores more efficient, so you can spend more time in work rather than having to do something else. So that depends. I mean, but definitely, I mean, from the data that I have seen, that much of these the credit, the retail credit, credit card and personal loans, etc., a large part of that is actually being used for consumer non-durables, not so much for services. Services are the travel and the other related things.
Right.
So even in services, services like education is a good use of a loan. Yeah, but not beyond a certain point. I mean, your ability to pay ultimately will determine to how much, to how beneficial some of those loans are.
Of course, and even things like travel could be a boost to wherever you're traveling, that area's economy. It's helping the travel sector, airlines or trains. So that also helps the economy.
Most certainly, unless it's travel abroad, which RBI data from the liberalized remittance scheme suggests that travel abroad has picked up significantly. So that benefits other countries. But travel inland, domestic travel is definitely a big boost for economic activity in various regions of the country. Yes.
Right, absolutely. So now on that note, we're going to end this conversation. What we know is that personal loans, credit card loans, some amount of unsecured loans are growing. They're growing quite robustly, but this is not a cause for worry, not yet, because the defaults are not growing at an astonishingly high rate. They're keeping to the level that they were earlier, and there's not enough indication right now that people are borrowing more because their incomes are facing stress. In fact, on the other hand, we are finding that a lot of this buying activity of houses, cars is happening also in tier 2, tier 3 cities and towns in India, which means that income levels there might actually be doing better. And apart from that, it looks like a lot of the debt is going towards people who are much more able to repay, the people in the super prime categories, the prime categories, and less so to the subprime. So things aren't looking that bad. So now you hear that, oh no, debt is growing and all of that, and that sounds kind of alarming. But if you look deeper, if you listen to experts like Mr. Bhattacharya, then you know that it's not yet time to worry. Of course, it's time to monitor the situation, and that the RBI has been saying the banks should do, and they're doing it. So on that note, that's all we have. Thank you so much for joining. And all of the subscribers, please do tell all of your friends, family members to subscribe to The Print so that you can take part in wonderful conversations like this. Thank you so much for watching.